When you think about toddlers, or children, what comes into your mind first is them cry. They can cry a lot. You know, toddlers and infants cry a lot. Toddlers, they play. Children, they play a lot. When you talk about youth, you talk about energy and adventure. Then mature adults, you you think about wisdom, particularly at old age. When you mention the stock market, what comes into your mind is risk. you know the stock market, investments, investing in the stock market, what comes into your mind is risk. So in this video, I want to talk about how to identify and manage stock markets investment risk. How do you identify this risk and how do you manage them? You cannot manage what you can identify. First of all, you should be able to identify them and then you manage this risk. So let's look at the various kinds of risks you could come across in the market. Number one is what is called market risk or systemic risk. Market risk or systemic risk. This is a risk of the overall market declining, affecting all the stocks or all securities to some degree. It is caused by factors like economic downturns, geopolitical events, or change in interest rates. This type of risk cannot be eliminated through diversification. You cannot eliminate this risk by diversifying your investment. A typical risk we could that affected the entire market was the COVID-19. It was really, really awful. It touched the entire market, and you couldn't diversify this risk away. You cannot mitigate it by diversification. It's a typical example of market risk. Another one is economic downturn. If the entire economy is down, it certainly affect the market, and you cannot do much about that. Number two is volatility risk. And this refers to the risk of stock price. Stock prices experiencing fluctuation. The market is bound to fluctuate in a short period. It can then result from factors like market sentiments, news, or earning reports. When earning reports are coming in, it will affect the markets. News of whatever kind, financial news, is bound to affect the market. Not only that, investor sentiments can equally have an impact in the market. So that volatility risk is something we must take into consideration. The next one is credit risk. That's credit default risk. The risk that a company will not be able to meet its debt obligation, or the company could go bankrupt, which can lead to loss of values of its stocks. It's particularly relevant for companies with weak balance sheets. When the company has a very poor fundamental, the balance sheet is weak, you discover that that company is prone to credit risk. The company may end up not being able to honor obligations to its bondholders, to its lenders. Then there could be that risk of default, defaulting on coupon rate for coupon, on interest rate for bonds, or maybe interest rate on the facilities from the bank. Number four is liquidity risk. Liquidity risk, that's the inability for investors to very easily sell their assets or buy an asset without affecting its price. It typically affects stocks with lower trading volume. So there will be no enough liquidity to move the stocks as expected. You want to buy, you may not be able to buy easily. You want to sell, you may not find a buyer. So this is what is considered as and considered liquidity risk. Number 5 is interest rate risk. Changes in interest rate can affect the stock market because rising interest rate would cost will lead to a higher borrowing cost, potentially reducing corporate profits. With while lower rates may have the opposite effect. If companies are borrowing at a high interest rate, then it will certainly affect them negatively because of the amount involved in servicing their loans. But if they borrow at a lower interest rate, they can do very well. They can really perform excellently because they have a lower amount of money to pay as interest, and they could borrow a large amount of money because the interest rate is low. So you consider interest rate risk, fluctuation in interest rate. Number 6 is inflation risk. This is the risk that inflation will erode the purchasing power of your returns, especially if you are a bond investor. You invest in bonds, you collect your interest or your coupon. You discover that the buying power of that interest is eaten up to some extent by inflation. It could equally eat part of the money you collect as dividends. So it's a risk that is worth considering. It decreases your overall, purchasing power of your dividends and your interest from bond coupon. Number 7 is reinvestment risk. This risk occurs when dividends or interest payment are reinvested at at a lower rate than expected, potentially reducing the overall return on the investments. Maybe you got your returns at a time when interest rate is low, and you invest at a lower interest rate. You discover that you will not make much money. Now, what is called reinvestment risk. But if you are able to invest when the interest rate is rising, then you could make more money. Number 8 is a country through political risk. Changes in government policies, political stability, or economic condition in a specific country can affect the stock market performance or of companies in that country. Let's take for instance now there's a crisis in Syria, there's a crisis in Lebanon. So if you own shares in those countries, then it's kind of risky. All right. So although it's relevant to those who invest internationally, but if you're just restricted to your country stock, you may not be exposed to country specific risk or political risk. Number 9 is sector or industry risk. Some sectors or industry may face unique risks. For example, technology stocks are highly sensitive to innovation cycles, while energy stocks can be affected by fluctuation in international price of maybe oil. The international price for oil can affect companies in this sector. When it comes to technology, there's that risk of either obsolescence or a particular technology coming in to disrupt an existing technology, risk of disruption. Number 10 is management risks. The performance of a company is heavily influenced by the quality of its management. So poor decision making, unethical practices, poor corporate governance, or changes in leadership can affect or impact stock performance negatively. Number 11 is event risk. This refers to the risk of a specific event, such as merger, acquisition, spin-off, takeover, natural disaster. All these factors may affect a company's stock price. Number 20 is currency risk. This is quite relevant for those who are investing abroad. This involves the psychological, or rather, this is for investors who are foreign investments. So this currency fluctuation can really affect the value of their return. So you know, uh, a strong currency can diminish the value of foreign investments, while a weak currency can enhance its value. If your country's currency is strong, relative to the company you are invested in, then you may have a lower return. You may have a lower return. It is called currency risk. Number 13 is behavioral risk. This involves the psychological biases of investors that can lead to poor decision making, such as panic selling during a market decline or overconfidence during market rallies. So both extremes are risky. Overconfidence is risky, and you know, so it can affect stock prices. So each of these risks requires different strategies to mitigate, and understanding them is essential for managing your stock market investment effectively. You must understand this risk and see how you can mitigate them. You can lower their impacts. It's very important.